Imagine a world where your money is as digital as your emails. Sounds incredible? That's the world of central bank digital currencies, or CBDCs. These aren't your regular banknotes or coins, but a new form of currency, born from the digital revolution that's sweeping across our financial landscape. CBDCs are essentially digital versions of a country's currency, issued and regulated by the central bank. Unlike traditional physical currencies that you can touch and feel, CBDCs exist solely in the virtual realm. Yet they hold the same value as their physical counterparts, representing a claim against the central bank rather than a bank or other financial institution. But how did we get here? It all began with the rise of digital payments, online banking, and cryptocurrencies. As these technologies gained traction, central banks worldwide started exploring the idea of issuing their own digital currencies. In essence, CBDCs are an attempt by governments to catch up with the digital revolution in finance. You might be wondering, is CBDC a form of cryptocurrency like Bitcoin? The answer is more nuanced than a simple yes or no. You see, while central bank digital currencies, or CBDCs, do utilize a form of blockchain technology much like cryptocurrencies, their essence is fundamentally different. The key distinction lies in centralization. CBDCs are centralized, issued and regulated by a country's central bank. They are a digital form of fiat money, and their value is tied to the real-world asset that they represent. On the other hand, cryptocurrencies like Bitcoin are decentralized. They operate independently of a central authority, and their value is not tied to a physical asset. They are typically not regulated, which leads to their notorious volatility. The decentralized nature of cryptocurrencies is what attracts many of their users, offering them a sense of autonomy and privacy. So, while CBDCs and cryptocurrencies may share some technological similarities, they represent very different philosophies of money. CBDCs come with a unique set of features and types, each catering to a different aspect of the financial ecosystem. One of the most significant features of CBDCs is security. Since they are issued and regulated by a central bank, they offer a level of security that's hard to match. This means that users can trust that their transactions are safe and secure. Another key feature of CBDCs is privacy. While they're not as private as some cryptocurrencies, they do offer a higher level of privacy than traditional banking systems. This is because CBDC transactions can be designed to be pseudonymous, similar to cash transactions. Efficiency is also a standout feature of CBDCs. They have the potential to make payments faster, cheaper, and more efficient, especially for cross-border transactions. This could revolutionize the way we do business and make international trade much smoother. Now let's delve into the two main types of CBDCs, wholesale and retail. Wholesale CBDCs are limited to use by financial institutions that hold reserves at a central bank. They have the potential to improve the efficiency and security of wholesale payments. On the other hand, retail CBDCs are designed for general public use. They could function as a secure, digital form of central bank money that everyone can use, a real game changer in the world of finance. As we can see, CBDCs are versatile and can adapt to various financial needs. Like any innovation, CBDCs come with their own set of advantages and challenges. First, let's talk about the positives. CBDCs have the potential to significantly improve financial inclusion. As digital currencies, they can be used by anyone with internet access, which can be a game changer for populations that are currently unbanked or underbanked. They can also facilitate faster and cheaper cross-border transactions, making it easier for businesses to operate internationally. CBDCs could also provide a more secure alternative to physical cash. They are not susceptible to physical theft or damage, and transactions can be traced, making it harder for criminal activity to go unnoticed. Plus, as they are issued by central banks, CBDCs have the backing of the full faith and credit of the government, providing a level of stability that cryptocurrencies like Bitcoin can't offer. However, CBDCs are not without their challenges. One of the main concerns is privacy. While the traceability of CBDC transactions can help prevent crime, it also means that governments could potentially monitor every transaction made by their citizens. This raises serious questions about how much privacy individuals are willing to sacrifice for the convenience and security of CBDCs. Another potential downside is the risk of cyber attacks. As digital currencies, CBDCs could be targeted by hackers, potentially resulting in financial loss for users and undermining confidence in the system. Despite these challenges, Several countries have begun exploring or implementing CBDCs. China, for instance, has already launched a pilot program for a digital yuan, and the Bahamas has introduced the sand dollar, the world's first fully deployed digital version of a national currency. In conclusion, CBDCs offer a host of potential benefits, from improved financial inclusion to increased security. However, they also present significant challenges, particularly around privacy and cybersecurity. As such, it will be critical for governments and central banks to address these issues effectively to ensure the successful adoption and use of CBDCs. While CBDCs promise a lot of benefits, their wide-scale adoption will depend on how these challenges are addressed. Now let's dive deeper into the key differences between CBDC and Bitcoin. One of the most significant differences lies in the field of decentralization. Bitcoin is decentralized, meaning it's not controlled by any single entity or institution. It operates on a network of computers worldwide, and any changes to its protocol require consensus among these computers. On the other hand, a CBDC, or Central Bank Digital Currency, is centralized and governed by a nation's central bank. This implies that control and regulation of the currency rest in the hands of a single authority. Next, we have the matter of anonymity. Bitcoin transactions, while not completely anonymous, offer a degree of privacy as the identities of the parties involved are shielded behind cryptographic addresses. However, with CBDCs, privacy could be a double-edged sword. While it could potentially offer the same level of anonymity as cash transactions, central banks might also opt to design their digital currencies in a way that allows them to monitor and track transactions, which could impact user privacy and freedom. Lastly, we have regulation. Bitcoin operates in a relatively unregulated environment. This lack of regulation can lead to volatility and unpredictability, but it also opens up opportunities for innovation and disruption. CBDCs, in contrast, would be heavily regulated by the issuing central bank, providing stability but potentially stifling innovation. In conclusion, while both CBDC and Bitcoin represent the future of money, they do so in very different ways. Thank you for watching our video on CBDC versus Bitcoin. If you found this video informative and want to stay updated on news and contrarian views on money, saving, and economics, don't forget to like and subscribe to our channel. Your support helps us create more content like this, content that helps you understand the rapidly evolving world of finance and the impact it may have on your life. And remember, always stay curious about the future of money. See you in the next video.